team meeting, which is on recent amendments in GST and Budget 2022. Today we have with us CA Sumit Setia and Advocate Shweta Gita speaker. Welcome, sir, madam. Welcome to Vice Chairman of Hyderabad Branch CA Deepak Ladda and our past Chairman CA Bana and welcome to both of you, sir. I welcome all the members and speakers once again. I request Vice Chairman CA Deepak Ladda to give overview of today's program, please.
Thank you, Secretary Satish Kumar ji. A warm welcome to all the members and speaker, the young and dynamic speaker from the BDO team, CA Sumit Setia ji and Advocate Shweta Girdhar ji. Welcome and thank you for accepting invitations of the Hyderabad branch and agreeing to consent to address our audience, target audience of chartered accountants from Hyderabad on a very important budget amendments. Friends, we all may be knowing that budget was presented on Union Budget was presented on 1st of Feb, and I'm sure many would have already gone to the budget by this time. And many of our chartered accountants are busy with the tax audit seasons, so that there may be chance that budget, as we all know, Nirmala Sitharaman has not told the complete budget and said that everything is annexed to the finance bill. So there are very hidden treasures in the finance bill as far as direct taxes as well as GST also. So we already had the very good finance bill direct taxes on the taken by Bhanu sir and Pankaj sir and followed by clause analysis by PVSS Prasad. So we thought indirect tax also required in detail presentation. The other day, Satish Saraf sir has told about the budget important amendments. So now, for taking us through the detail and the recent amendments, we have two young dynamic speakers, Sumit ji and Shweta ji. So welcome you all and wish you a very happy learning. Thank you, Secretary sir, for giving me the opportunity.
Thank you, Deepak ji. Before presenting the today's speakers, I request CA Banarendra YV, past Chairman of Hyderabad Branch, to give overview of today's program, please.
Thank you, Satish, and very warm good evening to all the participants and the speakers here. Friends, as you all know, this season, February will be a month where we'll be having a lot of discussions on the union budget, and we did have already some programs on the union budget conducted by Hyderabad branch. Not only Hyderabad branch, the SIRC, ICAI, and several branches across the length and breadth of India have been conducting programs on budget, and various learned speakers and resource persons have come on screen and explained the nuances of the proposed amendments to all of us. Today we have with us another two experts. I don't use the word budding experts because they're already flowered into experts, and we will be listening to the words of wisdom from them, and we'll enlighten ourselves much more with the knowledge that they share. Friends, Sumit Setia, chartered accountant, is well versed with GST provisions, and so is Shweta Giridhar, who is an advocate and is into indirect taxes practice. So we'll learn more about them when the secretary sir introduces them in a proper and in a very formal manner. And seeing them, we can say that earlier they used to say that the grayer the hair, the more value a professional like a lawyer or a doctor or a chartered accountant has. But times have changed, and we have moved on with the times. And gray hair is no longer a criteria for judging one's capabilities. Age has only become a number, and capabilities can be had by anybody. But only thing which I would like to repeat what our past president Devaraj Reddy sir used to always say from various platforms that he spoke. He used to say chartered accountants should not only have knowledge but also should have wisdom to shine in practice. And he used to very he used to give an example as to what is the difference between knowledge and wisdom in very simple terms so that everybody could easily understand. Knowing that according to the botanical labeling or the botanical bifurcation or classification is the better word, tomato is a fruit. So knowing that tomato is a fruit is called knowledge, but not using tomato in fruit salad is wisdom. So chartered accountants should have both knowledge as well as wisdom, because I have seen in my experience we have too much wisdom and we face a lot of problems with the departmental officials. So we should also too much of knowledge and we face problems with the departmental people. And it is only by using our wisdom we used to overcome them and get orders in favor of the client, or we could get our way through. So today I think they'll be handling on the indirect taxes of the budget, that is GST and other amendments. Though the finance minister's speech was sweet and short, the memorandums were quite lengthy, the memorandum explaining the amendments. So that itself shows that budgets always flatter to falter or deceive. So we'll have some important GST amendments are the additional conditions for availment of ITC, and some beneficial provisions also have been there, like extension in time limit to issue credit notes, and interest to be levied on ITC wrongly availed and also utilized. So all these things the learned speakers will be explaining in detail. So happy learning to all of you, and I compliment the team Hyderabad branch for selecting good speakers to enlighten all of us. Over to you, Secretary Sir. Thank you very much for giving me this opportunity.
Thank you, Bhanu sir, for your wonderful opening remarks. Now I am requesting CA Deepak or Vice Chairman to introduce Shweta Madam, please.
Thank you, Satish ji. It is my pleasure to introduce the first speaker of the day, Mrs. Shweta Girdhar. She is an advocate and become honors. She is having more than 7 years of experience in assisting array of clients in the field of indirect tax, litigations, compliance management, FTP, tax restructuring, due diligence, and GST audits. She has been working with very big corporates, Niratna, Navratna, real estate, pharma, and handled the matters before various forums, including high courts, tribunals, on a various very complicated matters. She has offered end-to-end assistance in SEZ units, implementing along with the subsequent recurring SEZ and GST compliance support. She is expert in offering end-to-end GST compliance, advisory, refund, litigation support, assessments, and various other related to various IT and manufacturing sectors for the GST related subjects. So with this, I present before the august audience, Advocate Shweta Girdhar.
Thanks for your
Now
time.
it's my privilege to introduce C.A. Sumit Setia. Sumit of Chartered Accountants of India, with 4+ years of experience in assisting area of clients in the fields of indirect tax, compliance management, due diligence, and GST audit. Sumit has a good experience for auditing and compliance during the articleship period of for various big corporate clients. His select key projects includes he offered end-to-end advisory support to implement seamless and tax efficient structure for Indian corporates for its GST implementation, end-to-end GST compliance, advisory, refund, litigation support, assessment, and audit services to several major clients such as IT, hospital chains, life insurance, banking, etc. He involved in various assignments related to monthly compliances related to GST. He is instrumental in indirect tax indirect tax health checkup for an international hospitality unit in Jaipur. In his previous role, Sumit was engaged in various projects, including post-implementation review of ERP software, designing tax models and reports on the software review. He supported clients belonging to healthcare sector on various assignments from an indirect tax perspective, focusing on potential risks and savings. Sumit has worked on various softwares like Tally, SAP, Oracle, etc. With a small brief profile, I'm presenting Sumit Setia. Sumit sir and Shweta madam, now the screen is yours. You please take care.
Thank you, sir. Thank you for this gesture. Thank you, everybody. So I would like to first share the screen. Let me know once the screen is visible.
Perfect.
Okay. Good evening, everybody. Good evening, audience. And thank you for this opportunity. Today's agenda, as our learned sir has already mentioned, that today's basic agenda is to cover the amendments or the recent changes via budget or through a notification recently, which are impacting severely to the taxpayers. We will be trying to cover in this session. Me and my colleague will take it up on a part-to-part basis, and accordingly, then at the end we will go with the question-answer session. So this is the broad, journey which we can take it through. Now, first thing is, before going to budget, I would like to cover a few prominent amendments which were announced or which were made effective from 1st January 2020. Why this date is critical? Because many of these amendments were brought through Finance Act 2021. So just to give a background, the current budget was Finance Act 2022. In the previous budget, there were many proposals which were passed by the Parliament, which were also approved by the President of India, but they were not made effective, because until unless the government makes issues a notification of its effective nature, we cannot treat it as an effective law or that provision. So there were many provisions which were proposed or which were passed in the earlier Finance Act 21, which are effective from 1st January 2022. So we will try to cover those and few important ones here, because that will also create a chain with the current amendments as well. Now, among that, the first one, and I'll go one by one. 1 second. Yeah. So the first one is changes relating to availment of ITC. Okay. So everybody must be knowing that earlier availment was basis 20% of the match. So for example, whatever credit you are availing in your books, that is basis the invoice. So that is the first step. So you will check the invoice and you will see there is a credit of 18 rupees GST that you will account as a ITC receivable in your books. Once that is recorded as a ITC receivable in your books, the next step is, in the subsequent month, when you file the return for the tax period, you will report that ITC. Now that is a very plain vanilla case, but what government has now intended is that only basis the invoice you cannot avail the credit, or you cannot report that ITC in GST returns. You should also see whether in the counter filing return status, that is Gstr 2B, that entry should be appearing as eligible. So there are two things. One is Gstr 2B, it should appear, and second, it should also come under the category of eligible. Once these two conditions are fulfilled broadly, then only you can avail the credit. Now, before this change was made effective, what was the provision? So just to make a comparison, earlier, assume in your books the credit was 105 for the particular month. Now, when you are comparing it with 2B, only 100 rupees was matching with 2B as eligible. So you will take 100 as is, there is no issue in that. Now, over and above, government had allowed, the authorities had allowed 5% of the matched as a eligible credit ad hoc. Okay, 5%. So in our case, 100 into 5% is 5 rupees. So total 105 was being claimed in our books. So 5 rupees excess we were claiming, though there was no entry in GSTR 2B. Okay, so this was the provision before 1st January 2022. What has happened post 1st January? Once this provision section 16(2) bracket AA. So I have quoted below section 16 bracket 2 subclause 2, and in that subclause AA. In that section, they have added one clause where this is a new clause wherein they say that credit or that invoice should also be reported by the supplier in his Gstr1 return. That is a condition. So once he reports in his Gstr1, automatically it will be available in my Gstr2B, subject to other condition which we will be discussing in the subsequent slides. Now that condition has been added. Earlier this was effective only through Rule 36(4). So Rule 36(4) is the rule which was brought in to curtail the credit availment basis the matching concept. Now this rule had no legal backing per se, and there were various high court judgments which my colleague will take it up. Now because of this, government wanted to negate those high court judgments broadly and bring in a effective law against that rules. The rule was Rule 36(4). Now that section 16(2) AA is effective. That means every invoice which is available in your in your ERP or your books should also be available in Gstr2B. That is, vendor should file as written. That is the condition you have to fulfill mandatorily. You cannot treat this as a procedural compliance, that okay, this is a procedural issue, I will still avail the credit. That may not be helpful going forward. So this is a very big change and which is made effective. So going forward from January month return, you cannot avail credit additionally basis the ratio percentage. Earlier it was 20% in October 2019. Later they reduced it to 10%. Then later they reduced it to 5%. Now the percentage is 0. So you cannot avail any credit ITC which is not matching with 2B. Okay, so now this will impact cash flows. This will impact the working capital of every industry, as this will reduce your ITC portion to that extent, which is not matching. So this is the one of the prominent effective notification issued from 1st January 2022. Again, I'm repeating, we haven't reached to the budget amendment yet. This is the recent changes or effective notifications made from 1st January 2022. That's the first one. Second one, changes related to self-assessed tax. So everybody must be knowing, you will be filing your Gstr1 return invoice level, okay, so that it appears in the customers or the recipients Gstr2B. Now, when you file your Gstr1, you have to report sales item by item, invoice by invoice. Assume you have reported a sale of 100 plus 18 rupees GST in your Gstr1 on 11th of subsequent month. Every month, subsequent month 11, you file Gstr1. Now, this return is only a disclosure in a way, because you don't pay taxes through this return. Gstr1 return is just to report the sales in to the government. Now, when you file Gstr3B by 20th, there you mention how much is the amount of tax you are gonna pay through credit and through cash. There are two means. Now you have to report the sales at a summary level again. Assume you have reported only 90 rupees as sales in your Gstr3B. However, in your Gstr1, you had reported 100. So this, what will this lead to is that you are not paying taxes on a turnover of 10 rupees differential amount. Correct? Now this is a clear difference between your Gstr1 versus 3B. So you are underpaying the taxes. I assume that this is a vanilla case. There are no adjustments. There can be other adjustments also, but this is a vanilla case where you by mistakenly or missed to report that 10 rupees differential sales in Gstr3B. Now this 10 rupees sales, okay, is technically a through demand and recovery, officer can recover this tax amount now. Earlier, he had to issue section 73, 74 notices, scrutiny, but now onwards, going forward under section 75, which is a chapter of demand and recovery, the officer can straight away proceed with the demand and recovery proceedings, and he can send you a demand notice saying that you haven't paid this much amount via Gstr 3B. However, you will anyhow get the opportunity of being heard. The principle of natural justice will be applied, but this will be little more if fast tracked, because there is a clear cut case of difference in your payable amount. So this is the second major amendment from 1st January 2022. Now the third one. So currently, and before when I say before January 1, 2022, so till December 31st, 2021, if you are not filing 3B for the previous month, you cannot file 3B for the subsequent month. This provision was there earlier, but similar provision was not available, or similar provision was not effective for Gstr1. So Gstr1 had no such condition, but with this section 59, rule 59 subclause 6. So with this, they have clearly now made effective that if you haven't filed your Gstr1 also in the previous month, you cannot file your 3B of the next month. Okay, so earlier, assume before this notification or the effective notification, you could have filed 3B of the subsequent month, even though you haven't filed Gstr1. But now, even non-filing of Gstr1 will lead to non-filing or non-operation of the Gstr 3B on government portal. So 1 and 3B are kept at the same pace. Either you don't file 3B or either you don't file 1. In either of the case, you will be unable to file the subsequent month Gstr1 or 3B. So we have to be very careful now with the written filings. Next is appeals. So there is a small change. So generally we see while goods are moving through transport by road, especially, there are certain checkposts or checking by the GST authorities. And in case there is a and in their view there is any wrong information reported vis-a-vis the physical goods available in that vehicle, they can issue a detention and seizure notice. Okay, that is governed by section 129. So section 129 mentions that if while scrutinizing the vehicle, if the officer is of the view that there is some tax evasion involved, or there is some wrong reporting in e-way bill, there are certain parameters. If there is any such case, then he can detain your goods or seize your goods. In that case, you have to pay a penalty of 200% of the tax amount. That is a penalty mentioned in section 129 in case of taxable goods. And in case of exempted, it is 2% of the value of goods. And this may vary basis the conditions. But assume that as a taxpayer, I am not in view of the officer that this is a mistake or there is a tax evasion involved. Everything is appropriate in my view. So I have all right to file an appeal. In such cases, earlier the pre-deposit technically, okay, for such appeal was only 10%. Now that in specific case of detention and seizure, the pre-deposit has been increased to 25% of penalty amount as a pre-deposit to file an appeal. Either if you want to file an appeal, you pay 25% of the penalty amount, and then only your appeal will be accepted. And the appeal provisions are covered under section 107. Appellate provisions are covered under section 107. So the proviso is added to section 107, saying that in case of appeal against the seizure or detention order, you have to pay 25% of the penalty amount covered in the note order. Generally, I'm just giving you a background. In other cases, if you want to file an appeal, you have to pay 10%, 10% as a pre-deposit to appeal any order by the tax officer. So this is on the appeal provision. This is also one important relevant, because many of the taxpayers are having movement of goods involved, and nowadays detention and seizure is a very common practice because of multiple reasons. So we have to be very careful that while filing an appeal, we should be ready with a 25% penalty as a pre-deposit. Now next is changes relating to e-commerce operators. And this is really interesting, and I would like to seek attention of all the audience here. So under GST, if you see, the liability to pay taxes is on the supplier. This is a general provision that if Sumit is supplying any goods to Shweta, Sumit will recover the GST from Shweta and pay the taxes to the government on behalf of Shweta, because it's an indirect tax. I am just acting as an agent technically on a very high level. But in case of few class of persons or class of business, the government has shifted the liability from supplier to the e-commerce operator. So one is the recipient, wherein we say RCM, reverse charge mechanism. That is in respect to the recipient paying the taxes against the supplier. But there is a third category which is covered under section 9 subsection 5 of CGST Act, which says neither the supplier, neither the recipient, both are not liable to pay taxes to the government. The e-commerce operator, aggregator, who is facilitating the supply of goods or services shall pay the taxes to the government. Okay, so this is, I'm just giving a background so that you can understand the amendment. So earlier, assume you are going via a taxi, metered taxi, you use Ola, Uber through your mobile, and you book a taxi. So currently, Ola and Uber is liable to discharge taxes, not the driver who is technically providing the service, because government has brought in those categories of services into section 9 subsection 5. That is, e-commerce operator is liable to discharge taxes. Okay, who is the supplier? Supplier is the driver who is driving the car, correct? Who is the recipient? Sumit, Shweta, anybody of you is the recipient, which we use Ola, Uber. Now, either of the persons are not liable to pay taxes, but the e-commerce operator, aggregator who is facilitating these services is liable to collect the taxes from the recipient and discharge it to the government. So this is section 9 subsection 5. Why government, why this provision is brought? And this is there since the inception. This is not something new. This is there because government cannot get hold of all the small service providers. So they want to just ensure the entire liability is collected and discharged by the aggregator, which is handling the entire volume across India, so that the jurisdiction administration is easy and the collection is efficient. So with this, now earlier there were metered taxis, hotels. So hotels also was covered there, and there were other examples. Now with this, they have also added restaurant services, okay, into this bucket from 1st January 2022. Earlier it was not covered. So earlier Swiggy, Zomato was not liable to pay taxes on behalf of the restaurant. Restaurant had to determine its tax liability and collect it from the end customer through Swiggy, Zomato, and pay to the government. Now government was for the government authorities, it was little challenging to reach out to every restaurant or to keep a track of every restaurant, whether they are discharging taxes appropriately or not. So for the same reasons, efficient collection of taxes and proper administration, they have shifted the entire tax liability payment or collection and payment from the restaurant to the aggregator. Aggregator example is Swiggy and Zomato. So they are now liable to pay taxes. So this is a new change, because, and this will impact a lot both the consumers and the restaurant providers as well. Because earlier an unregistered restaurant may not pay GST on its sales, but now because e-commerce aggregator has to discharge taxes irrespective of the threshold, so for every such sale, a GST of 5%, because restaurant generally covers under 5%, has to be discharged. So this is one of the, again, a major change in the tax levy. Earlier the tax levy was on restaurants. Now the tax levy is on the e-commerce operator, that is the aggregator. Hope I am clear till here. And again, we have mentioned the notification circular. So which will be helpful to read it through in detail. Now these were some GST amendments. Now few customs and very high level I'll just mention. Recently, so we follow a global HSN norms through World Trade, and they had made some changes in the HSN classification, harmonized system of nomenclature. Those changes helps us to align with the goods and service descriptions across the globe. Now these changes have also been made effective in the customs law. This will not entail to any custom rate changes. These are just to shift the customs tariff, the sequence and some descriptions, which will help us to align with the global HSN norms. So this will not have any monetary impact or a tax impact, but it will have a disclosure impact going forward. That's the point one from 1st January 2022. So everybody, if there is already a manual by the customs, so if anybody of us, any taxpayer is having a import and export transaction and any of your product is covered under those changes, please check that manual and please make accordingly changes in your bill of entry shipping bills going forward. So that is point one. The second point is there are various schemes announced by government from an indirect tax standpoint in customs, merchandise incentive, service export of India scheme, additional ad hoc incentive, ROSCTL, ROSL are for the textile industry. These all schemes technically, some or the other are being abolished or being revamped. For example, MEIS is now revamped by way of ROTTEP. Okay, so remission of duties and taxes. But for the earlier period, the claims are yet to be filed. So recently, the timelines have been changed and it has been extended up to 28th February for the MEIS, SEIS cases. So this is just a small update so that if anybody has missed to apply for any MEIS or SEIS claim, please do that ASAP because the last due date is 20th February 2022. And this is the second extended date. So we don't believe that we are not in a view that any more extension will be given. So please hurry up. If there is any pending claims on MEIS, SEIS, please do file it ASAP. So these amendments, what I have covered is prior to the budget and which were very recent, last 2-3 months or 1 or 2 months. Now we will cover the Indian Union Budget 2022-23 proposals in light of the indirect tax or in view of the indirect tax amendments. So direct tax is already covered as sir mentioned. We will be covering the indirect tax part here. In indirect tax, again, there will be GST and a customs FTP policy. So now here we will divide our slide deck. Shweta, my colleague, will take up GST and I will take up customs and excise in the subsequent slides. Before Shweta takes up, I'll just take up few key highlights in the budget for the benefit of the audience. So first thing, our current government's agenda or the objective is to create a Atmanirbhar Bharat, which is a buzzing word across India, so that again to keep that momentum alive and Make in India initiative, they have focused that in their budget speech and budget document also. A lot of rate changes in customs, rationalization, or also in a way leading to a situation wherein more goods should be manufactured or produced in India. So Atmanirbhar Bharat and Make in India are the two basic pillars on which they have focused their budget along with the growth. And secondly, digitalization. With this government, they are more focused with digitalization because GST also was aimed to bring digitalization in taxation system in direct taxes also. And this is also being followed in indirect taxes, including customs. So customs also, they have brought in a big digitalization reform, and we have to see how it is implemented, but the aim is good, wherein all the incentives which are being provided or exemptions which are being provided on imports currently are manual driven or physically driven. This is also being planned to digitalize end to end. So this we have to see in the subsequent months how they digitalize this via their customs portal. Second, racialization. They have racialized the custom duty raise to again promote Make in India, Atmanirbhar Bharat. Third, SEZ law. This is again very critical because SEZ law today is quite rigid in its approach and states are not actively involved. It's a central driven policy. So government is trying to amend this law or replace this legislation with a new law, which is more focused on ease of doing business and actively having the participation of the states as well. Fourth is GST amendments, and this my colleague will take up in detail. And there is a lot to cover in GST amendment. There are a lot of enforcement or powers to officers, while there is a little bit of facilitation as well. Then stringent provisions regarding input tax credit, the same thing. Then transfer of GST cash ledger. Currently, this is a very big issue across the with taxpayers having multiple registration, that some cash is pending in one GST registration, which we are unable to take a cash refund. So this can be transferred to the other GSTN within the same PAN, and this enabling provision is made. We have to see the fine print to in the subsequent month. No announcement regarding setting up of GST appellate tribunal. This is again which we were expecting as an industry consulting background, that because for every small thing reaching out to High Court is really difficult, and GST appellate tribunal, it's been 5 years now down the line and we don't see any GST appellate tribunal being formed. So these are the broad key highlights from indirect tax budget standpoint. Now I hand over my this presentation to Shweta. She will take up the GST amendments part. Thanks a lot. Over to you, Shweta.
Thanks, Amit. I'm just sharing my screen. Is my screen visible?
Yeah, it's visible. Yeah.
Yeah. So thanks, Amit, for secondly putting up the key highlights of the budget. I will go into detail of each provision which has been proposed to be amended via the finance bill. As you all may be aware, since the inception of GST, the GST Council meetings have acted as a pivot in terms of what the proposed amendments will be in the Act. Unlike the earlier regime where we used to anticipate a very huge list of budget changes, usually the GST Council gives us a heads up as to what is going to come in the budget, because more or less the government implements the recommendations of the GST Council. However, one surprise that has come up in the current budget is the amendment in the ITC provisions. Of course, what they have tried to do is only an rationalization from a perspective of removing all the provisions which were pertaining to the old return provisions which were never implemented. The Gstr 2 and 3, all provisions pertaining to that, they have revamped section 38. And also the wherever this old section 38 reference was given, all of those sections have been revamped. But while doing that, they have actually dropped a few bombs in terms of availment of ITC. As you all may be aware, currently the biggest concern for every taxpayer under GST is the ITC availment provisions, because one, while it is a very broad provision, unlike the old law, it allows credit for most of the items other than those specified under 17.5. The reconciliation with GSTR 2A earlier and now GSTR 2B has posed a big hardship for a lot of taxpayers, especially in the initial years of 17, 18, 18, 19. There was also a lot of litigation on this aspect as to whether requiring a reconciliation with GSTR 2A at all is valid, considering that there is no statutory backing for such auto-populated documents which are appearing in the portal, and there is nothing under section 16 as well which requires the assessee to reconcile it as such. While there was a blanket provision under section 16 which stated that unless the supplier has paid tax to the government, you may not be able to avail the credit. The assessees at various high courts have time and again argued that while section 16 specifies that the supplier has to have deposited the tax to the government, how will a recipient ensure that such tax has indeed been deposited. He can a genuine taxpayer at best can ensure that he is in possession of a valid tax invoice. He has received the services; those are not blocked under 17(5). He has paid the supplier within 180 days. Both the tax component as well as the value, and he has availed the credit within the time limit. These are the steps he can ensure to make sure that the credit is not invalid. Time and again, the ASIs have argued before the high courts that how can I ensure the supplier has actually paid to the government what I have paid to him. In fact, the Madras High Court in the case of DY Beethel Enterprises had resonated with the taxpayers' concern and had said that once you while the department has found out that the supplier has not paid the tax, then in such a case the department should also be able to establish what are the steps they have taken to recover the tax from the supplier. And the High Court actually came hard upon the department, saying, while you have taken no steps on the supplier after knowing that he has not paid tax, why are you directly proceeding against the recipient by denying him ITC? However, the government is not in the same line as the various high courts which have given relief on this issue. They are it appears that they are pretty keen on implementing the provisions based on reconciliation. So as Sumit was mentioning a couple of a while back regarding a new provision which was introduced with effect from January 2022, wherein it was said that the only credit can be, as additional condition was introduced under section 16, wherein they said only if the supplier reports in the statement of outward supplies, which is nothing but Gstr1, only then the credit can be availed by the recipient. So as a to complete that cycle, they've also introduced another clause in budget proposals where they have said that not only that the supplier should report in Gstr1, it should obviously reflect in the auto-populated statement under section 38. So section 38, which was earlier under Gstr2(3), has now been entirely revamped in line with Gstr2B now. And so they have said that it should appear in your Gstr2B, and only then your credit becomes valid. So now putting rest to all doubts, all litigations on this point, statutorily now they have brought in all safeguards to ensure that credit can be availed only when the supplier reports the transaction in his Gstr1 and that transaction is appearing in your Gstr2B as well. Apart from this, the section 16(a)(b), which has now been introduced, has another interesting aspect to it, which says that it should also be appearing in your Gstr2B and also not be restricted by that statement. So now this is a new thing. I mean, till now we were seeing whether it's appearing in our 2B or not, right? So now they have amended 38, wherein apart from not just showing you whether that credit is appearing, as per the Gstr1 of the supplier, now the Gstr2B, it might be updated to display a lot of other things. So what the Gstr2B will be doing going forward is that it will also show whether the credit is eligible or ineligible as per the portal. So till now there were only 2 occasions where the Gstr2B throws ineligibility as a criteria in the report. One is when the place of supply is not the place of recipient. So for example, like rental services, say a person is located in Hyderabad and he has taken a property, say a hotel accommodation, say in Maharashtra, and an invoice is received in Hyderabad's name, even though since the place of supply will not be in Hyderabad, that will be shown as ineligible. That is one situation. And the other situation is where the supplier is showing beyond the time limit. So in these 2 situations, currently Gstr2B shows that credit as ineligible. Now they have expanded the list, adding to the O's of the taxpayer by they have said that these scenarios also the credit will become ineligible. So some of these scenarios are that for instance, if the supplier has reported less in their 3B, than in the 1. That is, if there is a mismatch between the suppliers 1 and 3B, and he has shown turnover lesser than his 1 in his 3B, then in such a case, the credit reported by him might become ineligible to you. While this is an extreme kind of step to contain the credit, and we don't know how it will be implemented and how the report will be able to track so much data. We have to wait and watch, but this will be a big blow to the taxpayers in terms of availing credit, because you will not only have to ensure your 1 and 3B matches, you'll also have to ensure that all your vendors are like in they are good taxpayers and there's no default, and their 1 and 3B also matches. So they are trying to implement a mechanism of self-policing the supply chain, wherein one person polices the other person, and that way they want to trap all the tax leakages. And the other situation is that if they have not availed as per their 2B, so if their 2B shows say 100 as an amount, and if they have availed credit in 3B say as 120, in such a case also your 2B report will show that this particular vendor is not complying with the law. Therefore, the corresponding credit might become ineligible to you. So it appears that the government is really encouraged by the increasing tax collections, which is happening as a result of stricter ITC provisions. So based on that, they are seeking to tighten the screws of ITC availment even further, and it is going to be a pretty tough journey going forward for assessees as to how they will be tracking every vendor's tax compliance, whether they have complied with their 1 and 3B, whether they have followed their 2B. So this is going to be tough, and we don't know how it is going to be practically implemented and how 2B will be tracking this, and what will happen if subsequently if they correct it. For instance, if in a particular month, if a vendor has reported less in their 3B, but in subsequent month he has reported more. So in the first month, if the credit is shown ineligible, will the 2B get automatically updated? What happens to that? So should I keep track of all these things as well on a monthly basis? Is an ITC function in GST, is it going to be like a separate function where a person needs to keep track of all the vendor compliance? If we have to wait and watch and wait for more clarification and rules in this regard. The other aspect, while that was the most significant aspect pertaining to ITC, the other aspects, there are a few other aspects pertaining to ITC. One is, they have said that in a case where the supplier has been found not to have paid tax to the government, then they can recover the ITC from the recipient along with interest. It is something, the positive provision has been implemented. So earlier, while there was recovery, while there were notices seeking reversal of tax, there was no specific provision on this. Now there was a specific provision which has been introduced, which says that they can recover the ITC along with interest. Again, this utilization of ITC shall be subject to restrictions. So this, what we estimate is that this earlier there was this 1% rule, wherein 1% of the liability had to be paid in cash. This rule was introduced earlier. What we assume is that to give a statutory backing to that rule, this a provision has been introduced wherein they've said that even utilization of ITC can be subject to restrictions. The next one is a beneficial and a welcome amendment, wherein they have extended the time limit for availing ITC based on tax invoice and debit notes. So currently, taxpayers can avail ITC up to the time period of September return, so which is usually filed by October 20th. So we used to have time till October 20th of the after the end of the financial year, the following October, we had time till that. Now it has been extended to 30th November. So one interesting aspect is that what has been done is, instead of saying November returns or October returns, they have completely removed the word declaration in returns from the section, and they have just made it a due date. They have just said up to 30th November. So there are a couple of views emerging on this amendment. Some people are saying that this only means that we have time till 30th November. So you have to a maximum at best avail in October returns, for which you have time till 20th November. Even if you file belatedly by 10 days, they are giving you that leeway of 10 days. So even if you file belatedly by 10 days, you still have 30th November time. So what this provision in effect means is that you can take credit up to October returns. While there is another view that is emerging, which is that they have specifically consciously removed the words of declaration and returns. So this 30th November, when they say availment up to the before 30th November, it only means availment in the books of accounts of the taxpayer and not availment in any returns. While of course, when you avail in a particular tax period, you will report in the next tax period. Even if you don't report, assume for a scenario you do not report or you miss it and you report it, like say 3-4 tax periods later, even then, so if in your books of accounts you availed by say 1st November and you have reported say in say 20th December, even then it should be eligible, is another view that's emerging, that this provision has completely dealing the availment of ITC with the returns as such, and it's only with your books of accounts, is another view. While we have to wait for any clarifications from the board on this, currently, of course, the safer approach would be to, see to that we avail before like the 20th November, which is the October returns, so that any litigation on this can be avoided until, of course, the board clarifies that it actually means the books of accounts. So while we have discussed this 2B issues in detail, so some of the open issues on which we require more clarifications have been just bulleted here. So like I said earlier, so while in a particular month, if there's a 1 3B mismatch or a 2B 3B mismatch from the supplier's end, will I be given some time to follow up with them and to do course correction? Or if there is in the particular month, if there's a mismatch, the next month itself I can't avail. So is it going to be like that? Second thing is, of course, whether 2B is going to actually tell you whether each of the line items is going to be eligible or ineligible, and if should be strictly abide by it. So if there's any deviation, would it not be seen as okay if I have a valid stand, of course, because at the end of the day, 2B is an auto-generated AI-based report. There can always be exceptions to situations contemplated by the programmers at the time of creating 2B. So in those cases where even though 2B says ineligible, and if I bona fidely believe that it is eligible for various reasons that I am within the corners of law, can I go ahead and avail it, or will 2B be my sacred document that I cannot violate? So that is something, again, we need to wait and watch for clarifications on how this is going to be implemented, and whether will they be able to track so many data only in form of in 2B, and that is something we need to wait and watch. And again, how correctness of the report and how effective is the report, considering the technology, the strength of the technology used by a department we've seen in the past. So whether that is correct, like what happens when there's an update to the 2B. So all this is something we have to wait. And for instance, there's a scenario where there is a mistake by supplier, and he has done it after say 30th of November, this whatever course correction, whether if he pays by a challan or during audit. So in those cases, what happens to my credit? Obviously, my credit becomes time barred. So what do I do in such cases? Again, we'll have to wait. And is it prudent, once these proposed amendments become an act, is it prudent for all the taxpayers to actually modify their purchase orders, to actually insert clauses saying payments will be released only if, or having some penalty clauses or some indemnity clauses in cases where the supplier has not complied with the law, and because of which the taxpayer is suffering, the recipient is suffering from ineligibility of ITC. So that is something, it is very pertinent to revisit all the purchase orders and agreements, and whether any such clauses should be inserted in the POs and agreements. It should definitely be thought about, because definitely the quantum of credit is going to be huge, and there will always arise a scenario where the supplier has some kind of deviation from the law, not consciously. It can also be because of clerical errors and so many other reasons. So to protect the financial impact from any such happening, should there be indemnity clauses in the agreement, should there be any penalty clauses, is something all our tax teams should review about. So next, that is with respect to ITC. So next, I move on to the provisions relating to cancellation of registration. So I think this provision was already there. It is now earlier. Earlier the provision said that if a composition dealer does not file the tax returns for 3 tax periods, then they said that it could be cancelled. Now instead of 3 tax periods, they have said that 3 months. So there's not much of a change there. But in respect of non-composition dealers, what they have done is, earlier, if you do not file for more than 6 months, they could cancel the registration on a suo motu basis. But now they have removed the 6 months time period, and they said that it will be prescribed separately. So it might come in the rules. So there might be some guidelines on that as well. So we need to wait as to what will happen for the non-composition dealers. Again, as a consequence, like how we discussed for ITC availment based for tax invoice and debit notes, similarly the time limit for issuance of credit notes will also be extended on similar lines. So as you all are aware, section 34 of the CGST Act deals with the issuance of credit notes, and the GST credit notes could be issued only up to the September period, just like the other provisions under the Act. But this also has been extended up to 30th day of November. But here, and the tricky part is that, unlike the view we could take in the tax invoice or the debit note, where we could take a view that, if I recognize in my books of accounts, it's enough. Such a view cannot be taken under credit notes, because the provision reads in such a way that it should be declared before 30th day of November. So declared in the returns by 30th day of November, then the only possible interpretation could be that in October returns, which is filed by 20th of November, we have to declare the credit notes we have issued for that particular financial year. So again, the Gstr1 amendments which we could make, which was earlier open till September returns, now that has also been extended up to 30th November. And just like Sumit mentioned earlier, there was also always an option where you don't file GSTR 3B for a particular month. You could always file GSTR 1 of the next month. While that was not the case with 3B, for 1, the option was always open. But now they have made it such a way that both 1 and 3B should be filed for a tax period. Only then the next tax period you'll be able to file 1 or 3B. So a lot of companies which were facing cash flow issues used to file only the outward statement and not file the 3B, because you have to pay the tax amount through 3B. But going forward, if you're not able to file the 3B for your cash flow issues or various other reasons, your default will continue even for subsequent months until this particular tax period is resolved and you pay tax amount for that particular period. Regarding the next one is, of course, they have introduced under section 39 till now you're filing 3B on a self-assessment basis, right? So you assessed what is your taxable value during a particular tax period, and what is the tax rate applicable and the total tax payable, and a tax was being paid. So now they've also introduced another option that apart from self-assessment basis, tax can also be paid based on specific guidelines which may be issued. Again, the guidelines as may be prescribed is what they have used in the act. We have to wait for the rules to come out as to what they are going to propose under this, or whether are they referring to the existing QRMP scheme. So that is something we need to wait and see as to what is the other assessment basis that they are going to bring forward. Okay. Next is a very welcome amendment which is on the cash ledger balances which can be transferred. So currently the cash ledger balances could be transferred within the same registration. So you could transfer it from your CGST to IGST or IGST to SGST within the same registration. But now they have brought about a welcome amendment of transferring your cash ledger balance even inter-registration. That is, suppose if you have an excess cash ledger balance in Hyderabad in your Telangana registration, and in your, say if you have Karnataka registration where you're in a deficit and you don't have balance in the cash ledger there, you can transfer it from Telangana to Karnataka. However, they have restricted this transfer only from for CGST and IGST ledgers. They have not permitted this for SGST ledgers for obvious reasons, where interstate SGST cash ledger movement they are not allowing. However, one point that is to be noted is that, as I mentioned earlier, you can do within the same registration. You can always do this cash ledger transfers, and there's no restriction on doing for SGST. So if there is an excess SGST balance, you can, there is a possibility, it appears, we have to see how it might pan out practically. But in theory, it seems that there could be a possibility where you can transfer from your SGST to the CGST or IGST ledger. And from there, again from the CGST or IGST, you can transfer it interstate. So that appears to be a possibility as of now. Whether that will be restricted by the system or something, we have to wait and watch. But this is definitely a welcome amendment, because a lot of people who have huge cash ledger balances in one state and don't have cash ledger balances in other state can always manage their cash flow better now because of this amendment. So the next is pertaining to refunds. So while we are on this cash ledger, now they have also said that they'll be prescribing conditions based on which you could avail the refund of the cash ledger balance. In case you have excess balance in the cash ledger and you want to go for a refund of it without transferring it to any other registration, then in such a case, you may have to follow a method that may be prescribed in the rules. The next one is that till now for SEZ and SEZ developers, when we were supplying to SEZ and SEZ developers, is obviously treated as a zero-rated supply. But when ITC refund has to be claimed by the supplier, there was no specific relevant date which was mentioned in the section 54, which gives relevant date for various scenarios, so that the time limit of 2 years can be computed within which refund claim has to be filed. So to fill in that anomaly, what they have done is they have linked it to the due date of furnishing under section 39. So if a particular supply has been made, say in the month of February, then the due date falls in March. So from March, the 2 years will be computed for the purpose of computing the time limit under the refund under section 54. And the last one is the power to recover and withhold refunds, earlier which was confined only to subsection 3 of 54, now has been extended to all types of refunds. Even, for example, this special agency, UN and other special agency refunds under 54(2). Even in those cases, they have the power to recover and withhold the refund, which was earlier only restricted to unutilized ITC and inverted duty structure refund. Next is the interest amendment, which is a welcome amendment. This has been retrospectively amended in section 50, subclause 3 of the CGST Act, wherein the ITC Only if it is availed and utilized, they have said that interest will be applicable. Again, this is while there was a lot of ambiguity on this, now this has put rest to all the ambiguity and said that just because you avail some ineligible ITC or something that's not occurring in your 2A, it will not directly, you need not pay interest. Only if you avail it and utilize it, only then interest will be applicable. And they've also, what they've done is, earlier interest was at the rate of 24%. Now they have reduced it to 18% as well. So this is the, as you might be aware that this was a dispute even under the earlier Senvat credit rules, whether merely availing could, render the credit invalid, and whether I should pay interest. There has been this, the dispute was taken up to Supreme Court in the Senvat regime as well, and there it was settled that it had to be both availed and utilized. Of course, those judgments were being relied upon by the taxpayers under the GST regime. Now, putting a rest to all those litigation and unnecessary speculations, they have brought an amendment itself retrospectively from 1st July 17. Now, the proposals under the budget for GST has been covered. I now ask my colleague Sumit to cover the customs amendments.
Okay, thanks, Shweta. So we have covered predominantly GST amendments by now, budget amendments. The next one is the customs amendments, and customs amendments are quite relevant because of multiple reasons, which I'll cover one by one. And just to give a background, GST per se now, for example, rate changes. So rate changes in GST are generally now being carried out by GST Council, and the notifications are issued during that course of time. No one is waiting for the budget to make changes in the rates per se. So that's the reason you will not find significant changes in the GST law per se or rates through budgets. It's being divided into within the whole year. It's being split. In customs, because it is driven through central law, now it works in the same fashion as it was done earlier, that through budgets they'll bring the major amendments. So now one of the major amendments in customs is that Department of Revenue Intelligence, okay, this DRI, this was a big issue earlier, and in the case of Canon India, Supreme Court had said that DRI is not a proper officer for the purpose of carrying out investigation, adjudication, and etc. Now that was the Supreme Court judgment. Now with this change in the customs law, they have included DRI, that is Department of Revenue Intelligence, as a proper officer. Okay, now this is also done retrospectively and to negate the Supreme Court judgment. So the Supreme Court judgment in this case, to that extent of proper officer, is being negated, and now the DRI is also a proper officer, and technically then now they can issue notices, etc. In all the cases. So that's a one major amendment in this scenario of customs. Second is now generally when goods are imported, so the lower the value of the goods you mention in the bill of entry, the less is the custom duty collection to the government. So there were practices, or government is of the view that there are practices in market that people are undervaluing the goods just to evade or save the custom duties. Now to control, to restrict this, government has given powers through this act that they will bring in prescribed rules and regulations wherein the additional obligations are being imposed on the importer to prove or to substantiate whether this value is at an arm's length price or the correct price or not. So we are yet to get those additional obligations, but enabling powers in the law have been brought in. That's the second amendment. Third is importer exporter can withdraw advance ruling application and at any time before it's pronounced. It's a very simple one. So advance ruling, as we have in GST, we also have in customs, and that is now being two amendments. One is that before it is pronounced, you can anytime take back your advance ruling file. Second is, once advance ruling is pronounced, by default, it is only valid till 3 years from the date of the ruling. Okay, post that it is ineffective, that ruling is ineffective, or if there is any change in fact or law prior to 3 years also, it will be ineffective, whichever is earlier. So this is also a major aspect, and we have to wait and watch if such similar precedence is also used or such provision are also used in GST as well. Currently, advance rulings under GST has no such time limit. So we have to wait and watch whether this 3 years such time limit are also introduced in GST as well. Then next is publishing of import export data is an offense under custom. This is again just to restrict, because a lot of import export data is available in public domain through multiple sources, and this has now been made a punishable offense under custom. So this is just to curb that privacy issues or the data issues which is floating in the market. Then next is digitalization. As I mentioned, on customs front also, government is looking to digitalize many aspects. One of the important aspect which they are covering in this is the import exemptions which you claim currently are driven through a lot of manual and physical process. So this, they want to make it entirely end-to-end to the import of goods on the concessional rate of duties. There are IGCR rules. In those IGCR rules, government is bringing the entire automated process. So we have to wait and watch how they bring it. The last and very critical, the taxpayers here, the audience here, everyone should listen this carefully. Wherever on any imports, you are claiming the benefit of BCD exemption, basic custom duty exemption on imports through any method. For example, you are an EOU, STPI, so you claim the exemption. You are having an advanced license authorization, you're claiming a BCD exemption or any other exemption. So against that is one exemption. Now, there is a other entry called SWS, Social Welfare Surcharge, which was brought, I think, in Finance Act 2020 or 19. I'm really not sure, really sorry. So that SWS is applicable on the amount of BCD. So for example, the BCD is 100. So 10% of 100, that is 10 rupees SWS is to be paid as a social welfare surcharge. Now this surcharge is technically imposed on BCD, but there were instances from department and there were certain notices to our clients wherein certain EOUs were asked to pay SWS even though BCD is 0, that is exempt. That their contention was that you treat a notional value of BCD which was otherwise applicable, and then you discharge SWS at the rate 10% or whatever rate applicable. Now, as a welcome step, a positive step, the department, the board, CBIC board has issued a circular, and they themselves have confirmed or clarified this doubt that there will be no SWS payment wherever BCD is exempt. Now there are multiple notices, people would have paid SWS, and there are other issues also, because one can say that when I import or pay BCD via MEIS script or SCIS script, there also there is an exemption element. Will that case also cover in favor of the SWS also? So we have to wait and watch how this circular evolves during the time with the course of time. But this circular is a welcome step otherwise. And this circular is technically, is to negate or just to dilute the unicorn industry's judgment, though it is in favor of the, taxpayer. Now, under customs, because in GST we don't have major or we don't have through budget any major rate changes. In customs we have few. As I mentioned, the focus of the government is to promote Make in India, Atmanirbhar Bharat. So in that cases, they want to promote the capital goods production also in India. Earlier, there were exemptions for import of capital goods through project imports. So project import is a window wherein you just apply for it and you can import for the entire project capital goods at a flat rate, and that varies based on the exemptions or some reduced rates. Now government wants to rationalize this, and they don't want to incentivize companies to import for the capital goods. If it is necessary, you import, but you won't get special exemptions. Okay, they want to reduce those exemptions with the course of time, and they want to promote those production within India itself. So one of the major increase in the rates is through the project imports. Project imports customs rates have been increased, or exemptions have been removed. Rate on umbrellas, import of umbrellas, because we have the contention of the authorities is that we have enough capacity to produce umbrellas within India. So why do we import? So that's again, umbrellas custom duties has been increased. Intimation jewelry, diamond, solar cell and modules, again to promote that make in India. And there is a PLI scheme also, production link incentive scheme, against the solar cells and modules. So they want to, if the Indian industry has to produce in India, so they want some disincentivization on imports. So this is one of the way. And then X-ray machines. So all the view of the government is that we have enough internal or the Indian manufacturers available for these items. So let's promote that, and that's the reason they are increasing or one of the prominent reasons to increase the rates is this. Now, reduction in rates, everybody would be knowing globally the metal prices are increasing. Copper, steel, brass, everything is at an all-time high rate now. Just to maintain the inflation, and just to help the MSMEs also and other industries to manage their raw material sourcing through waste scrap, they have reduced the custom duty rates on the scrap currently, import of scrap. Then specified garments and fabric import also have been reduced, so that India can manufacture those fabrics and make the garments and everything. Then next is stainless steel. Again, duties have been reduced. Methyl alcohol and acetic acid, these are one of the few raw material for pharma companies for which the BCD rate have been reduced. There are few miscellaneous proposals also. Custom duties exemptions are being reviewed further. So our finance minister also mentioned in the budget speech that the custom duties exemptions are to be reviewed now more extensively, and there are chances that during the course of time they may remove or they may eliminate many exemptions. And if there is a really a long-term reason to have an exemption, they will change the base tariff rate itself rather than an exemption, so as to improve the rates rationalization. This is also a welcome step in a way that there will be a policy, from a policy standpoint, there is some sort of stability, because a tariff rate cannot be changed without a finance bill amendment, but an exemption can be. So when such exemptions are being built in within the tariff itself, this gives a policy stability also for the industry. So this is also a good step. Second, anti-dumping duty is being revoked on certain metals. Third is duties on drugs used for rare disease is being exempted, so as to, if there is a rare disease, there earlier we are in a lot of news articles we generally see that a vaccine or a medicine worth of 16 crores has a duty rate. So then government goes and gives some exemption. Now they on such rare disease, medicines, drugs, they have exempted the duties. One more interesting area where they have, so currently petrol is out of the purview of GST. So everybody know that petrol, diesel is out of the purview of GST, and currently excise from the central government and states levy VAT on the sale of petrol, diesel, or petroleum products. Sorry, petrol, diesel. Now, what government is intending as part of the clean energy initiative, and which is again just to bringing the Atmanirbhar Bharat, because this will reduce the dependency on the foreign fuel. So what they have said that from 1st October 2022, okay, not exactly now, but this is only just a proposal which will be effective from 1st October 22. Every petrol which is being sold by oil companies, IOCL, BPCL, Reliance, anybody, that petrol should have a blending of ethanol. Ethanol blending helps to reduce the carbon emission, and it's more, again, not exactly I know the scientific reason behind it, but it has some environmental friendly reasons, and it also helps the domestic industry. So they have made it in a way incentivizing that if you do a blending of ethanol with the petrol, that for that excise duty there will be no change. But if you don't add ethanol in the petrol, if you don't blend ethanol, the excise duty will increase by 2 rupees per liter. Okay, so this is really interesting because now they are technically incentivizing through taxation that please include ethanol in your petroleum so that your cost of production reduces by that amount. But again, there are various arguments that there is no percentage given that, for example, in 1,000 liters petrol, if I add 1 mug of ethanol, will it be sufficient to fulfill this condition? So we have to see again the conditions and the procedures to be followed to avail this benefit. So this is from a indirect tax background, indirect tax budget amendments, including customs and central excise till here. Now we will take a pause here. Satish sir, if you are okay. After this, yeah, after this we have few important rulings which have been pronounced during the next or the past 6 months or so, which are very relevant for the entire industry. Okay, before that, if there are any questions on the budgets, we would like to take that up once.
Definitely, sir, definitely.
Yeah.
Yeah, requesting members to pose any questions, sir, if you have. Sir, you want 1 or 2 minutes break? Better, no?
Yeah, it's fine, sir.
Yeah. Actually, no questions received so far.
Okay.
Just I will check. Let me check in chat or something. In chat also we don't have, sir. Anyway, if any questions are there, they will be posting in the QA portion. If you want to take a 1 minute or 2 minutes break, you can take. Otherwise, you can continue, sir.
No worries. We can continue. We just wanted to see if there are any questions. No worries.
No questions, Ajam.
Yeah. So Shweta will take up now the important rulings. These rulings, just to give a set of context, these rulings will cover advanced rulings, appellate advanced rulings, few high court judgments also. So this will again give a perspective that how GST is being pursued or interpreted by the court of law as well during this last 6 months or so. Over to you, Shweta. Shweta, you're on mute.
Yeah, I'm sorry, just a second.
Yeah, no worries.
Thanks, Sumit. So, as Sumit mentioned, we have now concluded the all the recent changes as well as the budget amendments on indirect tax. So now we'll move to some important rulings. If Sumit, please feel free to stop me anywhere and just add if in case you feel if I've missed out anything with respect.
Definitely. Yeah.
Yeah. So the first ruling is a very important ruling for all the real estate developers there. So this was actually a pretty contended issue. In fact, there are some 4 rulings on the same point of a sale of a developed plot. As you might have all have come across situations where the real estate developers sell developed plots which are like earmarked with proper drainage facilities, common street lights, compound wall, etc. And those developed plots are earmarked and sold to the interested buyers based on the super built up area and not precisely based on the number of square yards or square feet. So the question which was raised before the Appellate Advance Ruling Authority of Gujarat here was that when a developed plot is sold, is only a land being sold there, which is outside the purview of GST under the Schedule 3, or is the construction service being provided to the taxpayer, is it to the customer? That is the that was the query which was put before the Appellate Advanced Ruling Authority. So here, what the assessee was doing was that they were, as I mentioned, they were taking a large parcel of land, demarcating into small parcels of land, building compound walls, laying drainage lines, common street lines and electricity lines, and also water connection, water connection which the Panchayat provides, that the pipes were also laid. And after doing this, the developed plot was sold to the interested buyers. One pertinent point to note was that as per the Panchayat regulations as well, it was mandatory that the taxpayer had to give such basic amenities before the selling of land. So to comply with the Panchayat's regulation as well, they were complying with these, they were ensuring these facilities were available to the interested buyers. Now, what the taxpayer argued was that even though they did some basic work of draining a drainage line or a water pipe, a water facility or a compound wall, what they were still selling was only a land, and it was not, they were not constructing any building or any any civil structure there, and that civil structure is not being sold. At the end of the day, the interested buyer is coming to him only for the purpose of the land, and they are not interested in any building which is raised. They are also trying to contend that they were complying or laying all these common facilities only to fulfill the requirement of the Panchayat, and this was not the intention of the sale. And the taxpayer also argued that this should be seen as a composite supply, wherein the principal supply is the sale of land. Since the principal supply is outside the purview of GST, so the entire transaction should be outside the purview of GST. And this construction activity, which constituted a minuscule portion of the total value of land, should not be treated as a separate service activity, is what was argued by the assessee here. But unfortunately, what the appellate authority did not agree with the view of the assessee. And what the authority said was that the primary argument of the assessee was that it is a composite supply, hence the entire activity becomes an exempt supply. I mean, becomes a non-taxable supply. And the authority went into the definition of composite supply, and it said, first of all, it should, if there are two taxable supplies, out of which one is two taxable supplies which are supplied in conjunction with each other and are bundled, only then you can apply the definition of composite supply. In a case where land which is entirely outside the purview of GST because of its presence under Schedule 3, the authority was of the view that this composite supply definition itself may not be applicable, and hence this and hence the shelter taken by the assessee that it's a composite supply, and hence the entire activity should be treated as a land transaction, was rejected. And secondly, what the authority also held was that you are doing various activities to make that land a saleable land, such as drainage facilities or compound wall, which involves substantial efforts, and hence what you are doing is actually a construction service for the client. They are not coming to buy from you any land. They are coming to buy from you a developed land, and hence what you are doing is only a construction activity for the customer, and this is not a pure plain vanilla sale of land transaction which is excluded from GST. And hence in that background, they held that the entire value becomes taxable at the rate of 18%. And as a construction service. So as I mentioned earlier, there were a couple of rulings on this point. In fact, there was also a Karnataka Advanced Ruling Authority, and there were two rulings, in fact, which held that this was not a construction activity. It's only incidental to the sale of land. The land remains the land. and what was sold was not any constructed building, but what was sold still remained land. And the Karnataka authority had taken such a view and held that this construction incidental activity cannot alter the entire transaction. But unfortunately, the appellate authority did not agree with the Karnataka ruling held in those two cases, and held that what they are doing is indeed a construction activity, and it cannot be considered as a pure land activity. This might come as a big blow to various real estate companies, because a lot of them are involved in selling developed plots. As you might know, the value of land will be much larger than the value of the construction activity, which will be very minuscule in comparison with the value of land. Now, treating the entire transaction as a construction activity will increase the cost of the entire land by 18%, which will be a very high, it will affect the competitiveness for the buyer as well. So we'll have to wait and see whether there's going to be any circular or at least any valuation mechanism which will be introduced by the board by way of a circular or a notification, so that at least the entire transaction value should not be taxable at 18%, since the construction activity still remains very minuscule. Just like how for the solar industry they had introduced a 70-30 ratio, wherein they said that since the major part of the transaction involved the supply of the solar devices, which constitute the major value, you take 70% as that value, only 30% as service activity. Something like that should be done in this regard as well. Either they should clarify that the entire transaction is only a sale of land, or they should bring some valuation mechanism. Otherwise, this will increase the hardship of the taxpayers as well as the buyers, because it's increased the cost of procuring the land at a significant level. Because 18% really changes the game for a lot of buyers. So we'll have to wait and see, or maybe we might also can expect some representations be filed on this. So that it is brought to the attention of the council as well, that such an appellate ruling is there. Unfortunately, while advance ruling mechanism was helps in a lot of cases, in such cases there's no other further remedy as well. So unless the board or the council interferes, we'll have to see how this pans out. So the next ruling is indeed a very landmark ruling by the appellate authority in Madhya Pradesh appellate authority in Bharat Oman refineries. So in this particular ruling, the authority had an occasion to consider a variety of recoveries done by the companies from their employees. This will definitely be an impact for all the all the companies, irrespective of whatever industry they are in, because whether or not these such as notice pay or canteen recovery or mediclaim policy, these are being done by, irrespective of which industry they belong to, these are being done across all the industry. And this is definitely it is really good that the advanced ruling authority took a broader view on this and gave a positive order, and it is one of the very few occasions where advanced ruling authority has given a big relief to the assessees. So this is definitely important, and I really urge you to pay attention to this this particular ruling. So here the question which was posed before the authority was that, and the assessee was recovering a lot of amount from the employees for various activities, such as, for example, in case of a mediclaim policy, in a lot of cases, a lot of companies have a policy where you could add your parents or your non-dependent parents or your retired parents as a part of the company's mediclaim policy, but a certain amount on actuals would be recovered from the employees, and this would include the cover for the parents as well. So the question before the authority was whether, when such an amount was recovered from the employees, would that amount to a supply which is being provided to the employees, or because of its employee-employee relationship, will this be excluded? This was the question which was posed. So what the view that the authority took was that merely because some amount is being recovered, you cannot presume there's a supply. So the first thing they held was that whatever amounts that was being recovered from the employees was on cost to cost basis, and no margin was added by the company as such. So the insurance company gave an estimate of this much will be the premium in case parents are added. The same amount was recovered from the employees and no margin was added by the employer. So that being the case, there is no independent service provided by the company as such. In that regard was what the authority held. And they also said that if the company is in the business of refinery business, you cannot say that they were actually providing mediclaim services to their employees. So what they were doing was merely recovering for a welfare activity, and this cannot be said that it is in the course of furtherance of business. So that is the term they interpreted. They said that for any activity to constitute a supply, it has to be in the course of furtherance of business. Since this is not what they do as a business, and this was merely a recovery, they said that it is not taxable. It's not, it will not be separately taxable. The similar view was also taken for various other recoveries, such as for providing telephone facilities or for providing canteen services. So in fact, canteen services, what happened in this scenario, which may be the scenario in a lot of companies, was that partly the company was bearing the cost and partly was recovered from the employee. And the total amount put together as a pool was paid to the contractor. So the authority again observed that what was paid to the contractor was exactly what was, a sum of what they had contributed and what the employees contributed. Since the company did not enjoy any margin in it, and the company does not at any point intend to provide a canteen service to the employees, and since this facility was being done as only as a welfare activity, since this was mandated under the Factories Act, it was held that this is not in the course of furtherance of the company's business, and hence this will not be taxable in the hands of the company for mere recovery from the employees. So this is for the facility recovery which was done by the company. Apart from that, the authority also had a chance to examine about the notice pay recovery. Again, this is a very contentious issue. I'm sure most of the companies have this particular scenario wherein if an employee, without serving a particular notice period as agreed under the employment contract, say for instance, he had a notice period of say 3 months, but instead he wants to get relieved in 1 month. So there are a lot of situations where the company, the new company in which the employee is going to move to, will be willing to buy out the notice period from the employee, and so they will be sponsoring for the remaining period, and they'll say whatever is the notice pay, I will ensure you get we contribute that, you pay to your company and you get relieved early. So a lot of employees, what they do is for the remaining 2 months which they don't want to work, whatever is the notice pay, which is as per the company's policy, they'll have to pay an amount to the company and get relieved earlier. Instead of serving say 3 months notice period, they will serve say 1 month notice period and pay extra money to the company for this activity. So interestingly, the department has been taking a consistent view that this will amount to tolerating an act of the employee, that is the company is tolerating the fact that the employee is getting relieved early, and hence this becomes a service, is what the department has been taking a view. This is not a new issue. This has been there from the service tax regime, where many notices were issued on this notice pay, and many parties were contesting that as well. Interestingly, the Madras High Court, under the earlier regime in GT&D, which has been mentioned in the slide as well, they had taken a view that this notice pay, there is no toleration of any act. It is only it was only an amount which was being recovered as per the contractual terms. It was more like a damages for breaching of the contract, and hence the Madras High Court had held in the context of service tax regime that you cannot levy service tax on notice pay recovery, because there's no supply that the company is making to the employee. The employee is paying what was due under the contract, and there's no corresponding supply by the company. I think someone has raised their hand.
You please continue in the meanwhile, madam.
Okay, sure.
Yeah.
So
We will ask in the end.
sure, sir. Yeah. What the authority has held that even though the Madras High Court had held that the notice pay is not taxable in the context of service tax, the provisions under GST is identical to that of service tax, and they have said that the same rationale or ratio decidendi can also be used under the can also be used under GST as well. And they followed the Madras High Court decision and said that notice pay cannot be made taxable. So this again is a very welcome decision, considering there are many disputes on this and many people, but there are contrary views on this, and some taxpayers are paying tax, some people are not paying, and there's no consistency on this. So this appellate ruling should definitely bring more clarity in the on the subject, and people can take more consistent views, and considering that it's an appellate authority ruling as well. This Bharathaman refineries is definitely a landmark decision in the last year, which came at the fag end of the year. So this will definitely help to reduce a lot of disputes with the government. In fact, one good thing is that for in the same lines as Bharathaman refineries, there are many decisions which have now come, such as Tata Motors and others, which have held that recovery from employees is not taxable. So again, is a welcome trend which has kind of cleared the ambiguity in this area.
Just to add one point, Shweta. So as rightly mentioned by Shweta, this is a landmark judgment. Now, because this is a contentious issue every time, whether to pay taxes on the recovery from employees, and there are multiple grounds, multiple views by industry, by government, by taxpayers. One good thing should happen, and with this ruling, is that government may also come up with a clarification, because AAAR at the end of the day is not bound, is only bound by that applicant, the taxpayer who has filed that application. Though there are positive rulings, again we can take inference, but we cannot take it as a matter of right. To make it clear, to make the this issue very clear, government also should come ahead and issue a clarification on this. That would be the best thing in respect to the employee recoveries, because every industry would have some or the other employee recovery, and this is a very common issue. So we urge the authorities or the government to issue a clarification on this, whether we are going ahead with the same position, or because as Shweta mentioned, there are positive rulings. There are many negative rulings also at the same time, but there are less. But predominantly there are positive on this. So how do we take a position unless government comes up with a clarification or some amendment in the law to cover this aspect? So that is one point to ponder in respect to the employee recovery specifically. Over to Shweta. Thank you.
Yeah, that's right, Sumit, because as Sumit was mentioning, there are a few negative rulings as well. It will be good that if any board circular is issued on this point. The next ruling by Cummins India is also an appellate authority ruling. This is also a very, very important ruling, and it is applicable across industry, and it's not confined to any particular taxpayer or particular industry. So this is with respect to companies, where there are multiple branches for a company, and which are distinct persons under the GST law. How to apportion your common expenses. So that was the issue that was raised before the appellate authority in Cummins India. So as you may be aware, the landmark ruling of the appellate authority in Columbia, Asia, was the first ruling on this aspect, as to when there are common services which are rendered at the HO, such as the employer, such as, like, for example, the CFO's function, or the or basically the corporate office's function for the branch. So whether it should be cross-charged or not, one, and two, whether common input services which are received at the head office, whether it can be passed on to the respective branches by way of a cross-charge invoice, or should an ISD registration be mandatorily taken. So these were the two issues that were raised by Cummins India before the appellate authority in Maharashtra. So what the authority has held is that, one, for distributing common credit, ISD is the only mechanism. They said that ISD is not an option. It's a mandatory registration registration to be taken in case you want to distribute common credit. There is no other way you can distribute common credit. So they have said that if there are many common invoices that you are receiving at the HO, which you want to proportionately apportion to each branch, then the only route you can take is through by taking an ISD registration and following the procedure, filing the return, and in the manner in which the proportion has to be done. All the procedure needs to be followed, and then only you can apportion it. Second thing they have held is that if there are common credits, apart from an ISD registration, the head office registration independently cannot avail the credit itself, because of the fact that Section 16 requires that the credit needs to be consumed, needs to be received and used at the by a taxpayer for them to avail the ITC. What the authority has held is that when the credits are actually being used by the branch offices, the head office cannot take in their books of accounts the credit. Even if it's for passing on, they may not be able to take the credit because it does not fulfill the conditions of Section 16 of the CGST Act. So because of this reason as well, they have said that ISD route is the only way to distribute common credit. So this is with respect to credit that they have clarified. The other aspect that they have clarified is that when there are common facilitation or common corporate office, whatever common services, employee services are being done on behalf of the entire company, it has to be allocated to the respective branches, and GST would be applicable on it, and the valuation provisions needs to be followed for valuing those services. That is either on cost basis or any other reasonable basis. You need to value the services, and it needs to be apportioned to the respective respective branches, has also been held by the authority. Again, this is a very it is an unsettling judgment in terms of how will you apportion the cost of your own employees to other registrations, how you will be valuing it, how can you determine open market value, because you can't determine open market value. Of course, they have said that whatever value is the tax invoice, that will be deemed to be open market value. But again, how will you determine those value, whether you have to do this activity on a monthly basis? So this needs to be reviewed, because this is a second ruling on the same subject. Already Columbia Asia has held that you have to value these services and apportion it to the respective branches. So it's only a matter of time before the department starts applying these judgments, even though they are not directly binding on other assessees. They might start applying these judgments, and they might start denying IT, either denying ITC or demanding tax from the HO, saying that you have not apportioned your common costs. Again, for those companies who are currently not following the ISD mechanism but merely cross-charging their credits, again, it is time to have a relook and evaluate and take a legal position on this, because ISD has been held to be the only mechanism in which common credit could be passed on, and they have said that ISD registration is not an optional registration. ISD registration is a mandatory registration in case you want to apportion the common credit. So this is a significant decision which the industry has to evaluate and also take a call as to what would be the best way forward to avoid any tax impact in the future, because considering this two-way issues and all this died on, these notices died on, I'm sure the department will start picking up more substantial issues like these. And at that time, all the taxpayers might be flooded at the same time such notices. This definitely deserves the attention of the industry right now. So the next ruling is a Telangana Advanced Authority ruling. Here the question was pertaining to place of supply. So here what happened was the applicant was doing some inspection services for a foreign party. So they were receiving the consideration in foreign currency. They were, but however, the activity that they were doing was in India. So they were doing some inspection with respect to goods which were ultimately going to be exported. They were first inspecting here, and for that they were raising an invoice and they were receiving the currency in foreign currency. So the question that was raised before the authority was whether this could constitute as an export of service, because ultimately they are providing it to a foreign party, and two, they were receiving also in foreign currency. However, what the authority held was that in this particular case, it may not be it may not constitute an export, because a rule as per the as per the place of provision section under the IGST Act, in case of performance-based services, the place where the services are actually performed needs to be taken into account. And since these inspection services had to be done only in India because the goods were located in India, so the player supply would be in India, and hence it was held that it will not be treated as an export, and the player supply is within India, and it will be a taxable activity. So this is again important, because normally, generally, the presumption is that once you are having a customer outside India and you're receiving in foreign currency, a lot of taxpayers tend to draw a conclusion that it will definitely become an export. But it is very important to go through the place of supply rules and discover where each of the nature of supply falls under, and whether, as per the place of supply rules, the place of supply is outside India, because the export definition definitely requires that one of the important condition in the export of supply of service outside India, for the export of service outside India, is that the place of service supply should also be outside India. So hence this ruling is important, especially in those performance-based services. Yeah. Okay. The next case is slightly different in terms of the what they had sought before the authority. So the assessee here was actually in the bullion business. So they were supplying gold. So they were procuring, they were trading in gold. So it so happened the assessee also started another line of business, another business vertical, wherein they were supplying castor oil seeds. While these seem to be entirely unrelated businesses, they were doing this under the same registration. Now, what was raised before the authority was that, suppose in case they had some accumulated, they had some ITC which they had procured for the purpose of their bullion business, can they utilize that ITC for outward tax payment in respect of their castor oil business? That was the question before the authority. In fact, the advanced ruling authority in this case had held that you cannot do it because they are not attributable to that business, so you cannot interchange those credits. The applicant approached the appellate authority as well. What the appellate authority had held is that once a particular credit comes into the common pool in the electronic credit ledger of the in the GST portal, it does not really matter in which for taxable activity are you utilizing that credit for. There is no such restriction under section 16, and they have said that once it comes to the common pool, you're free to utilize for any of your business verticals, since ITC is a fungible fungible asset. It's not there's no one-to-one correlation that I have to if I am doing, say, I'm selling, say, medicine A, I have to only use the credit of the inputs which I procured for manufacture of medicine A. There's no such rule like that. Once it comes into the common pool, I am free to utilize the credit for any of my taxable activities, as long as I fulfill the other conditions under section 16, and if the particular credit is not blocked under section 17(5). So the appellate authority had set aside the advanced ruling authority and held that the credit can be utilized. There is nothing wrong in that. Okay. this is again, this is similar to this Bharat Toman refineries, which I already discussed. So here they had recovered, the employees were providing some cab services for their employers were providing cab services for their employees, and they were also recovering some partial amount for that activity. So partially the cost was being absorbed by the company, and partially the cost was being recovered from the employees. So whether the question which was raised before the Maharashtra authority was whether the services, the transport, whether the amount recovered for transportation facility provided to employees, will it be considered as a separate taxable activity, or will it be considered as a it's only a recovery of the cost basis? So here as well, the authority had taken a view that the taxpayer is actually not providing any transportation facility. It is only facilitating the transportation facility for the employees as a welfare measure, and they were recovering on an actual cost basis. And because of this, there is no independent supply by the company, and hence in those set of facts, the authority held that this is not a taxable supply. So this is again in line with what the appellate authority had taken a view in Bharat Oman refineries as well. So they have said that since there is no margin added to the recovery of cost, this is not an independent supply in itself. So the last judgment which I will be addressing here is the High Court judgment in the case of BMG Informatics. It's a Guwahati High Court judgment. So this judgment had actually this petition, writ petition which was filed before the High Court had actually challenged the circular number 135 of 2020, which is a refund circular. What aspect of it was challenged was that in terms of inverted duty structure, this circular addresses one particular issue, which says that in case there is any change in rate of tax, if suppose there's a trader who's procuring the same product and also selling the same product, there is no value addition from his end, but due to some circumstance, a circumstance where at the time of procurement the GST rate was different, while at the time of sale the GST rate was different, because of that, if some inverted duty structure arises and there's some accumulation of credit, in such cases, the circular had clarified that you cannot go for a refund under this section 54, because the intention of section 54 is to cover only in cases where your inputs are of a higher rate and your output is a lesser rate. If you're trading in the same commodity and you both in input and output, and the accumulation is only because of the reason of rate change, then a refund under 54 cannot be entertained, is what the circular had clarified. In this particular case, the BMG Informatics had approached the Guwahati High Court and had filed a writ petition saying the department had rejected their refund, relying entirely on the circular. However, the circular is entirely contradictory to section 54.3, because section 54.3 does not require any value addition from the assessee. What it says is that if there is any accumulation because of your tax rate difference between an input and output, then a refund can be granted. It does not require or mandate any kind of value addition from an assessee's end. So the assessee argued before the court that this circular is contrary to 54, and hence it was beyond the statutory provision, and hence it should be struck down. The Guwahati High Court accepted the arguments of the assessee and said that yes, section 54 does not require you to manufacture or value add to the products you're procuring. You can procure the same product, but still there might be a rate difference because of various reasons, such as some GST notification could have come in the interim period, or any of such cases. In such a case, you can definitely go for a refund under 54.3 on account of inverted duty structure. And the Guwahati High Court directed the authority to consider the claim again and grant a refund. So this is again a significant decision, and for some traders who are dealing with the same product where there's a rate change. So with that, I conclude the important rulings and judgments. So if there's any questions, we'll be more than happy to take it now.
Shweta, we have one question here.
Yes, sir.
Question from A. Vikram Singh. Can GST authorities issue notice for ITC reversal on the basis of advance ruling cut to be some other assessee. Can you please answer this one?
Yeah, sure, sir. So under the advanced ruling provisions, it's been very clearly mentioned that it is applicable only for the persons approaching the advanced ruling authority. It cannot be used as a precedent for any other assessee. However, you can't preclude the fact that the department will get ideas from the arguments taken by the assessees before and the authorities' observations as well. And based on those observations, they can definitely issue a notice. While advanced ruling authority cannot be the basis for notice, they can definitely pick up points from the advanced ruling decision and they can issue notice. But they can also mention in the notice, while it's not binding, it is definitely persuasive. Even when they go to a court, definitely there's already a ruling and they've issued notice based on the ruling. While it's not binding, it's definitely persuasive.
Thank you, Shweta. Member, if you have any questions, please write in the Q&A box. Thank you, both of you, Shweta and Sumit. Before members posing any questions, I request here Banarendra sir to give closing remarks while addressing this one. Waiting for questions.
Thank you, Satish. It was a good jugalbandi by both the young experts on the subject. They not only dealt with GST, but also some of the customs provisions and the legal implications. And it was very well presented program. And compliments to you for selecting good speakers. And I think the entire session, throughout the session, we had an average attendance of 120 plus.
Yes,
so that is that too on a working day during tax audit season is very good. And hats off to both of you. I think we require more of your presence on the screen on behalf of Hyderabad branch in times to come. Kindly, whenever possible, kindly do spare some time for us. And I know it will be only the more you share, we'll have more knowledgeable CAs around, and that is a great thing that can happen to the profession. So with these two words, officially our secretary sir will be proposing the vote of thanks. But anyway, it was a good presentation, and the only question asked has been answered very promptly, and it was a crisp question, and answer was also crisp. And I think Shweta ji has also told that we cannot be complacent in advance rulings, because they get ideas. That is the right word. The department gets ideas and they try to do a lot of mischief. And I would say it is mischief only. So thank you very much once again. And thanks to all the participants for being with us today and making the program a success, because success cannot be spelt without you. So thank you once again. Over to Satish ji for your official vote of thanks.
Yeah, thank you, Banu sir, for your wonderful closing remarks. We really privileged to have you as senior here. On behalf of Hyderabad branch, we sincerely thank to Shweta madam and Smith bhai for accepting our request to address this. And what do you say? It is a crisp, lucid, and power-packed presentation. Thank you both of you for engaging for these 2 hours with our wonderful presentation. As a token of appreciation and gratitude, please accept our virtual certificate from Hyderabad branch. Initially, first, Shweta ji.
Thank you. Thank you so much for giving us both the opportunity to come and share our thoughts on the recent changes. It was really a pleasure talking, sir.
Sumit ji, your certificate came first. Thank you very much. Please accept our virtual certificate application. Keep on, what do you say? Yes, accepting our request to address the system. We are privileged to have you here today. Thank you, Sumit bhai. Just 1 minute, sir.
Yeah, it's visible. Yeah.
Visible, sir?
Yeah, visible.
Yeah.
Yes, sir. Thank you.
Yes, Robert.
So just to add one point to Banu sir's comment, I would
Yeah.
just say going forward, we would like physical face-to-face rather than screen time. More screen time rather than screen time, because screen time is not two-way communication. Maybe physical is two-way communication. It's more interactive in nature than those sessions.
Yeah. Shortly, I think branch is planning to go back to the physical mode of
Yes, sir. Yes, sir.
conducting meetings, because presently the classrooms, there is advanced IIT and NCS and all, we are shifting to physical mode. So very soon we'll be having meetings, at least some large meetings will be holding in the physical mode, because there is only one constraint, two constraints to be honest, with the speakers. One is people have got used to online, and taking out time coming all the way to the branch, finding a place for parking, and then coming is going to be a challenge. Of course, for bigger meetings which we hold at bigger venues like star hotels or convention halls, I think we'll have very good attendance, and they will be half a day or whole day programs. But these programs we will start on trial basis, and we will see, because going forward we have to definitely have a physical interaction, because that way the speakers will have also the satisfaction that they have been properly able to communicate their point of view to the viewers. Though there may be a few viewers, but they will be the persons who are really interested in the subject, and who can understand the subject in a very proper manner, and also raise very interesting questions out of their practical experience, or whatever doubts they have, uh, whatever doubts that they get while applying these provisions of law. So definitely we'll be switching over to the physical mode. At least some meetings will be definitely physical mode from going forward. The new committee, which is due shortly, will take a call on that.
Thank you, Banu sir. Sorry to ask you, due to some technical problem, both the certificates appeared here, sir?
Yeah, both the certificates we saw on the screen. Yes,
from
sir.
my side, some technical problem.
Yeah.
Before winding up the session, for the information of members, tomorrow evening at 5 p.m. We have CA Ujjwal Jindal from New Delhi, who is going to address virtually on gearing up for ROC annual filings and annual returns. Please join at 5 p.m. sharp tomorrow evening at 5 p.m. With this, we are winding up this session. Thank you once again, each and everyone, all the members, all the speakers, and Banu sir. Thank you once again. Thank you all. Yeah.